Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lonking Holdings Limited annual report. Lonking Holdings Limited offers a diverse range of businesses and services through its three main segments. At the core of its operations is the sale of construction machinery segment, which provides a variety of construction equipment including wheel loaders, excavators, forklifts, road rollers, skid steer loaders, and parts centers. In addition to selling construction machinery, Lonking Holdings also offers finance leases for these machines through its finance lease of construction machinery segment. This allows customers to acquire the necessary equipment while spreading out the costs over time. The company's financial investment segment provides further diversification by offering financial investments and distribution services. Specifically, it distributes oil products, which complements its existing construction machinery business. Overall, Lonking Holdings Limited has established itself as a comprehensive provider of construction equipment and related services in mainland China and internationally. Lonking Holdings Limited maintains a market capitalization of $13 billion, broadly in line with the industry peer group. Lonking Holdings Limited trades at a lower price-to-earnings ratio of 9 times and a lower price-to-book ratio of 1.01 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 31% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 6.51%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth and decline are multifaceted and influenced by various market factors. On the growth side, finance lease construction has been a significant contributor, with an increase of RMB 11,215,184. Additionally, loaders revenue has seen a notable surge of 15%, reaching RMB 4,838,119. The export sales have also played a crucial role, generating RMB 3,806 million in revenue. Furthermore, the demand for heavy construction machinery, particularly wheel loaders and excavators, has been on the rise. On the other hand, the decline in revenue can be attributed to several factors. Forklift sales have experienced a year-on-year decline, while traditional forklift operations have contracted. Market price competition and slow transformation have also hindered growth in this segment. These opposing forces highlight the complexities of market dynamics and the need for businesses to adapt and innovate in response to changing consumer demands and market trends. The net income of the company experienced a significant increase, rising by RMB 182 million from RMB 1,019 million to RMB 1,301 million. However, this growth was not uniform across all product lines. The net income declined by 7.04% for forklifts and 14.05% for skid steer loaders. Despite the fluctuations in net income, the company's profit margins showed a notable improvement. The gross profit margin increased by 1.81 percentage points from 19.56% to 21.37%. This increase was also observed in the forklift segment, where the profit margin rose to 21.25%. These changes suggest that the company has been able to optimize its operations and pricing strategies, leading to higher profitability despite some product line-specific declines. The company's financial performance indicates a strong ability to generate cash from its core operations. The net inflow of RMB $245 million from operating activities on page 31 demonstrates a significant increase in cash generation. Furthermore, the substantial rise in cash and bank balances by approximately RMB 3,149 million also underscores this trend. This positive operating cash flow is consistently supported across multiple pages, including page 19 and page 20, which collectively reinforce the company's ability to generate cash from its core operations. This suggests a stable financial foundation for the company, enabling it to meet its obligations and invest in future growth initiatives. The company's debt level has undergone a substantial transformation in recent years. In 2024, the company had no time deposits or interest-bearing bank borrowings, indicating a relatively low debt burden. However, by 2025, this picture changed dramatically, with time deposits increasing to RMB 590,403 and interest-bearing bank borrowings rising to RMB 20,000. This significant increase in debt levels suggests that the company has taken on more financial obligations. In contrast to the changes in debt level, there is no clear indication of a significant change in interest expenses. Despite the substantial rise in debt, the provided information does not reveal any notable increase or decrease in interest expenses. The company's financial performance was mixed across various segments and regions. Notable performers included the finance lease segment, which generated RMB 11,215,184 in revenue, and the construction and financial investment segments, which both performed well. The overseas market also saw a significant year-on-year growth of 19.32%, driven by increased demand for infrastructure machinery and excavators. In terms of specific products, loaders experienced a notable increase in sales proportion to 43.14%, while excavators benefited from domestic demand recovery and sustained overseas demand. The Northwest region was another standout performer, with a notable increase in revenue. On the other hand, some segments and regions underperformed. The construction machinery segment reported a negative result of RMB 70, while the finance lease segment had a poor performance with a negative result of RMB 82. Forklifts also underperformed, with a decreased sales proportion by 5.59 percentage points. The South region was another area of concern, contributing only 8.16% to total revenue. Overall, these results suggest that the company's growth is being driven by its overseas market and certain product segments, while some domestic regions and products require improvement. Management's outlook on company strategy. The company's management team has been contemplating a significant strategic move by exploring equity investments. This decision suggests that the company is looking to expand its financial capabilities and potentially diversify its revenue streams through partnerships or collaborations with other organizations. By investing in equity, the company can gain access to new markets, technologies, and expertise, which may help drive growth and increase competitiveness in the industry. There are no notable acquisitions or divestitures to report. The company has chosen not to engage in any significant transactions involving the purchase or sale of assets or businesses. This decision reflects a strategic focus on internal growth and development, rather than external expansion through mergers and acquisitions. As a result, the company's operations and resources remain focused on its core activities and goals. There are growing concerns among businesses and industry experts regarding inventory buildup. This phenomenon occurs when companies accumulate excessive stock levels of goods, often due to overestimation of demand or inefficient supply chain management. As a result, inventory buildup can lead to wasted resources, increased storage costs, and reduced cash flow. The issue of inventory buildup is further exacerbated by the risk of supply chain disruption. Disruptions in the supply chain can occur due to various factors such as natural disasters, transportation delays, or supplier insolvency. When these disruptions happen, companies may struggle to meet customer demand, leading to stockouts and lost sales. In extreme cases, inventory buildup can become a significant liability for businesses, requiring costly write-offs and impacting their bottom line. To mitigate the risks associated with inventory buildup and supply chain disruption, companies must adopt more agile and responsive supply chain strategies. This includes implementing just-in-time inventory management systems, diversifying suppliers to reduce reliance on single sources, and investing in logistics and transportation infrastructure. By taking proactive steps to manage inventory levels and mitigate supply chain risk, businesses can minimize the likelihood of inventory buildup and ensure a smoother flow of goods to meet customer demand. That concludes the financial summary for Lonking Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.